Okay, ladies and gentlemen, welcome to MACROACE with your host, Tony. I am also the head financial analyst at FinancialJuice. Hello, Lorena. Hello there. Let's go through. We've got a little bit to cover. Of course, we've got both the non-farm payrolls data from the US and the Canadian employment change data at the same time. So we've got quite a bit to go through. So non-farm payrolls, let's start off with that. First of all, what is non-farm payrolls? It represents the net amount of jobs created within the prior month. And your house, so the way that the non-farm payroll survey is made up. So you have the household survey, which is where the unemployment rate figure is derived from. Then you have the establishment survey, which surveys 660,000 corporate and government work sites. And that's seen as a more comprehensive, more detailed report of how strong the jobs market is or the labor market is within the US, because they're getting data directly from the employers rather than people who are employed, who might provide less clearer or less clearer picture of what their situation is like. So if we carry on then how does it affect the economy? The key basics of this is that with the currency, whenever you see a strong amount of jobs being added to the economy in the prior month, usually that gives a strong push or boost, or you see a bullish reaction from the dollar. The reason being is that if there are more jobs being added to the economy, then one, the economy is shown to be healthy. Two, and in this current environment, you've also got to remember is that with the central bank's tightening cycle, that any amount of jobs, any strong figures in the job market that are presented, then the Federal Reserve will likely take that stance and think, or like to take that data and think, okay, if the job market continues to heat up, then that has a higher chance to cause a knock-on effect on inflation too. The more people have jobs, the more spending that there is available. And of course, prices, the higher the chance that there is for prices to go higher as well. So that's one of the worries that the central bank has about the strong jobs market. But then going back to the first point I made about the currency, if the economy is doing well and is healthy, there's also the fact that if during, let's say, a potential, or if there is an onset recession, or during a recession, that the economy is showing strong labor market figures, then that could give a boost of confidence to people trading in the dollar, and also for the stock market too. So within a non-hiking environment, usually for the stock market, a higher than expected figure is good. Again, it means that there is that those businesses are able to hire more people to then be more productive, and then in turn, those people or them who have been hired have more money to spend on the goods and services that those businesses provide, and then stock valuations start to go up. But of course, as we know at the moment, a better than expected jobs figure leads to the central bank thinking that they need to tighten more. And in turn, you see a bearish reaction usually from the stock market, and what we've seen over the past more than a year or so, more than a year of tightening from the central bank, or let's say the rate hiking cycle from the central bank with the Federal Reserve. So usually in this environment, it's you generally see a bearish reaction for the stock market if you do get better than expected data. For the bond market, bond yields usually go up in anticipation that the central bank is going to tighten monetary policy, and in turn those yields start to go higher, particularly the short-term bonds, right? That's where you start to see, when you get the inverted yield curve, is because there is the anticipation that with higher rates by the central bank, that's going to have a knock-on effect to the economy, where it's flashing signs of a potential recession, or the likelihood of a recession becomes stronger. Hence, you see the short-term bills, like the 3-month or 6-month, being higher than the long-end bonds, because they're the most sensitive to the rate changes with the short-term rates. Now, for bond prices, of course, if you're not sure how bond works, when the government sells their debt, they provide the bond at, if the bond is at a higher price, the yield is lower, and then vice versa. If the Federal Reserve is expected to hike rates, then bond yields go higher and bond prices go lower. Okay. Again, you have traders and investors who are anticipating the central bank, raising interest rates, and that will naturally will cause bond yields to go higher. Now, the next point to make is, we have to understand what are the current indicators that are weighing on sentiment at the moment, right? You can't just look at the non-farm payrolls figure itself and say, yeah, the US is doing well, or whichever country it is. You've got to understand what other indicators are there that could influence how the markets could play out at 8:30 a.m. Eastern Time. So first of all, inflation at 4% compared to 4.9%. PEC price index was lower as well at 3.8% compared to 4.3%. GDP data Q1 final read was at 2% compared to Q4's 2.6%. Unemployment rate ticked high at 3.7% compared to 3.4%. The ISM manufacturing employment data that we had this week was at 48.1 compared to 51.4. And the ISM manufacturing PMI was at 46 compared to 46.9. ISM services employment index was at 53.1 compared to 49.2. The services PMI itself from the ISM was at 53.9 compared to 50.3. So just off the back of that, right, just off those ISM figures, you can see that there is a continual decline in the manufacturing sector of the US economy, according to ISM. But in the services side, that's where things are picking up a lot more. Now, remember, of course, during the COVID pandemic, there wasn't much production, or there weren't any services being provided. But you can see here that now that there is more of a leaning towards luxury goods and luxury services, or high-end services, or services that are being provided in general. And remember, this is for businesses. So though you've got to understand, for the ISM services PMI, that it's representing businesses using services to then provide their goods and maybe their own services to consumers. Then the JOLTS job openings data, which we had this week, was at 9.824 million compared to 10.103 million. Employment cost was at 1.2% compared to 1%, and ADP employment change, which is very important for how non-farm payrolls could react, was at 497k compared to the prior of 278k. So we'll go through what the reaction looked like for ADP, because, as I said, that's going to be quite important for us to understand what non-farm payrolls could do to the markets depending on which way it goes. So, but before we do that, we'll go look at the triggers. So, non-farm payrolls, the high estimate of what economists are looking at is at 350k, with a low estimate of 110k. So, the deviation then of what, if we're looking at the current median estimate for non-farm payrolls, current median estimate is 230k. So, economists are expecting on the high end, for the expectation of about a 125k deviation, and then on the low end 115k. Then if we look at the unemployment rate, so the unemployment rates, they see a high estimate of 3.8% compared to a low estimate of 3.5%. And then if we carry on, average hourly earnings is also going to be key too. So this could be the deciding factor as to how the report might react. So ADP doesn't include average hourly earnings as an economic release, or as a figure. And we've seen in the past where the employment data might be weak, but then you have the average hourly earnings. Again, the wage price pressures that come in have taken hold of the markets, and then caused the markets to go in one direction. So that's something that we have to be aware of. So the higher estimate of what average earning, what economists are looking at, high estimate of 4.3% compared to a low estimate of 4.2%. So generally, I think with the average hourly earnings, so the median estimate is 4.2%. So ideally ourselves would be looking at 4.1% for the low end to get a decent reaction. But of course, that depends on what the other data presents us as well at the same time. Private payrolls, high estimate of 325k with a low of 115k. If we're looking at investment bank views then, so Bank of America sees 250k and JP Morgan sees the headline figure at 260, Societe Generale 250k as well, and Citi at 170k. Then the previous report from June 2nd, so in May, job gains occurred in professional, business services, government, healthcare, construction, transportation, warehousing, and social assistance. So there was a decent, again, a continuation of jobs being added to the economy when in this, with rates already being quite high at the moment in the US. So the other key point is the establishment survey doesn't show a significant change in the number of people employed in all industries. So yes, there are a solid amount of jobs being added to the economy, but the difference between each report isn't that big, or isn't is significant enough to cause, let's say, for the Fed to have a lot of worries about the job market and then how that could have an impact on the inflation reports that we have coming up. And then Fed and government views. So Fed's Powell on June 14th said that the key to non-housing service disinflation, i.e. if you're looking at restaurants, haircuts, and those kind of services, disinflation is to get loosening in the labor market conditions. Fed's Goolsbee on June 30th said that if the labor market is too hot, then we will have a hard time bringing down inflation. From the Fed minutes on July 5th, they mentioned that those favoring an increase noted a very tight labor market and stronger than anticipated economic momentum, and that there is little evidence of inflation being on a path to return to 2% target over time. And a lot of that was baked in when they were expecting from the Fed members in the SAP, or the Summary of Economic Projections, or they're expecting 2 more to rate hikes. Is what there was kind of looked at or presented to traders, which led to, of course, the idea that the Fed isn't done with their hiking cycle when they thought they would have been, even though they had taken a pause at the last meeting, that there is still more tightening that needs to occur. And if that does mean 2 more 25s or maybe 150, if that happens, then again, the jobs data is going to be quite key to keep an eye out for. If you have, again, the central bank members, of course, I've picked comments about the labor market, but that's still, of course, that goes hand in hand with CPI figures, and it goes hand in hand with CPI figures. If CPI does become too high, then usually that can be influenced heavily. Does get influenced heavily by the amount of jobs that are created every month. Feds Williams says the economy still has strong demand for labor, and Feds Logan says we are skeptical on the large consequence of rate hike lag effects, and more Fed rate hikes are likely necessary. So Feds Logan. So all in all, we've got this image that's being presented that even though we've reached quite a high rate within the US in such a short amount of time, that the jobs market is shown to be resilient at the moment. So the only fear is, if the jobs market continues to be resilient, how will that then affect the Fed's goal of trying to bring down inflation? And again, that's where the traders' sentiment shifts from, okay, good data is now good data and bad data is bad data, back to good data is bad data for the stock market and bad data is good data. But that's kind of yet to be seen to how the markets will react today to the non-farm payrolls figure. Investment bank views and sentiment. So post ADP, you had Horizon Investments saying that the strength of the labor market pushes out the idea of a possible recession. But then Morgan Stanley jumps in, and again, this is post the release yesterday. They said that ADP report can be volatile and isn't necessarily a good predictor of monthly jobs reports, and that is more comprehensive. So we know that, and we've seen in the past where sometimes there isn't really a strong correlation, i.e., if ADP comes in high, if ADP shows an increase in jobs being made compared to the forecast, some people will say then non-farm payrolls, or the figure itself, is going to show the same thing. No, it's not. Not all the time. So people do use it as a forecasting tool, or as a way to foreshadow what the Friday figure will be, but there hasn't always been a strong correlation. It's been quite mixed. So sometimes you'll get a really poor ADP report, but then non-farm payrolls might be really good. So again, just to make you guys aware, then that's what happens. And this is what happened with ADP. This was a market reaction yesterday. So this is why, going back to how the markets might react today, if we do get a positive non-farm payrolls figure, what I'm trying to say is I'm not trying to predict which way the figure is going to go. What I'm trying to show here is that if you do have better than expected data, how could the market react with non-farm payrolls? Okay, so if you do get better than expected data, could you see what we had seen yesterday, where you had seen the dollar fly in the air for quite a while, and then everywhere else in the stock side and bonds, bond futures and gold taking a hit instead. So as shown here, the forecast was 225k, 497k, blitzed it, right? Cracked it out, it beat it out of the market, okay? And it didn't. The stock market didn't stand a chance with a figure. That was a 272k deviation on that figure. And this was a market reaction that we've seen. So not too much of a market reaction on the S&P, but a bigger reaction in other areas, in other assets, in currencies, in metals, and in bonds. Bitcoin, actually, when I looked at it, the reaction wasn't that big either. It more or less mirrored the S&P. It was kind of dead. So we will have a look at Bitcoin today, because I know people in the past have said, "Where's Bitcoin? Why are we not showing the coin?" So I will pop that up as well. Okay, so this is the last reaction. Okay, so I'll kind of skip ahead. And it's on June 2nd. Okay. So this is about 5 seconds before the release on June 2nd. Let me kind of skip ahead. You can kind of see it there. So you can see that stronger than expected figure. There was an initial move towards the downside on the S&P, strengthening on the dollar. Bond prices or bond futures headed down. That's the 2-year bond price in the top right there, ZT bond futures there. So you'd seen that movement towards the downside, and then you actually see that the reaction didn't really last that long on the S&P 500. One of the things is that you had average hourly earnings that did tick down, and the unemployment rate ticked up as well. So what does that mean? Is that the bad data is still good data, and good data is still bad data for the stock market. But the headline figure did was much stronger than expected, which led to the initial move down on the S&P. So if I look at the deviations here, let me kind of go pause that here. That's in the first minutes of trading, so you can see it reversed quite quickly on the S&P. So let me bring the deviations here for you. Hold on. Let's close this. So deviations here, looking at how the S&P, looking at what the deviation was. So we had a 144k deviation, right, which was much higher than what what traders or what economists were expecting for the high and low estimates. So that's one thing to be aware of, that if you do have data that is better than expected, keep an eye out on that average hourly earnings figure as well. Don't just put it off altogether. Like I said, you've got to look at everything, not just the headline figure itself. So ideally, the biggest moves that we'd seen in the currencies was the dollar yen. Of course, that's to do with the Bank of Japan still continuing with their monetary easing. So whenever you get any economic release, you likely see more volatility within the dollar yen compared to some of the other currency pairs. Okay. And again, 2-year bond prices, 2-year bond futures had seen the bigger reaction compared to the 30-year. Okay. All right. One thing to note though is that on the Nasdaq, it had a cleaner move compared to the S&P and the Dow. So that's also one thing to just bear in mind as well, that what had happened last time when we had that figure there. Okay, so we've got about 9 minutes. We're going to go to Canada. So let's bring up Canada. Okay. So Canada, let's kind of blitz through it quickly. We already know what employment data is. Previous report, you had seen wholesale retail trade adding 24,000 jobs, transportation warehousing about 17,000, information tech and cultural recreation plus 16k, educational service 15k, business and other support services about minus 14k. If we keep going on, so if we keep going here, so the interest rates, as we'd seen before, did tick up to 4.75% compared to 4.5%. That was a surprise rate hike by the Bank of Canada. Inflation report at 3.4% compared to 4.4%. GDP quarter-on-quarter annualized was at 3.1% compared to Q4 0%. GDP month-to-month is unchanged. The employment change last time was at minus 17.3k compared to 41.4k. And the unemployment rate at 5.2% compared to 5%. And the S&P manufacturing PMI at 48.9 compared to 49. So just make a slight edit with the previous slides that I had. So just going through the last report that we had. So just to clarify that point here. So in building support business, you had a job loss of minus 31k, and services minus 13k, manufacturing employment increase in manufacturing by 13k, other services 11k, and utilities 4.2k. So just kind of clarify that last point, that last slide there. Okay, going back to the report then. So triggers then for the employment change, high estimate of what economists are looking at is 54.5k with a 35k deviation, and a low end of low forecast of minus 15k, again with a 35k deviation. Unemployment rate, the C high estimate of 5.4% with a low estimate of 5.1%. Sentiment and views of central banks then. Bank of Canada's Deputy Governor Burdi, when asked whether the bank has a tightening bias, so that nothing is determined and that they're looking forward. So again, same thing as just saying the data is going to determine which way we go, whether we continue hiking interest rates or whether we take a pause and then reverse and go the other way. So nothing really surprising there. But from the RBC on July 3rd, they say that though Canadian labour markets remain exceptionally tight, job openings have been trending lower, down 21% from the peak levels as of April. Almost half of businesses are still reporting labor shortages as a key frustration, as limiting their sales of production, and they're still looking for a 20k increase in the employment figures in June. So don't forget, if you found this information useful, don't forget to give it a like, share the video, subscribe to the channel, get the word out there, and let's continue. So investment bank views, CIBC, they see 20k, Scotiabank sees 40k, BMO sees 30k, and Bank of America sees minus 15k. Then if we look at the, again, if we look at the last report that we had last time, if we kind of go forward. All right, here we go. So this is about 5 seconds before the last report that we had for the Canadian employment change data. So you can see that the data was worse than expected, and you'd seen weakening from the Canadian dollar from that data there. So again, if we're looking at the, if we keep an eye on what the deviations was for the economic release, if we go through that here for you. So with the Canadian employment change, you had about a 38.5k deviation from the headline figure. So what does that mean for ourselves? I think we're looking for at least about a 40k deviation to see maybe a similar reaction. That's in either way, by the way, for the Canadian employment change data. So we can see that the biggest market reaction from the currency pair was from GBP CAD this time round. Usually it's been more or less a mix between CAD JPY and GBP CAD, but last time around it was GBP CAD with about 40.9 pips towards the upside. So just to clarify what these brackets mean here as well, so we can see here, so this figure, or this shows the initial move going to the wick of the candle, and this shows you the move going to the end of the candle 10 minutes after the release has occurred. And if it doesn't have a word, if it doesn't have a word here saying up or down, usually means it's going, it just means it's going in the same direction with the market reaction move. Just to kind of clarify that there with you. So we've got about less than 2 minutes left. So I think either CAD JPY, GBP CAD will be interesting to keep an eye out for the economic release, as we'd seen last time around. And looking for, I think, as I said, economists look for about a 35k deviation with the high and low estimates. I would probably look at a 40k deviation on our side. All right, 1 minute to go now. So let's get out of that here. Okay, let's bring up GBP CAD. Got quite a bit of... Okay. 1 minute to go. Let's get our TICKSTRIKE up and running. Okay. Okay, 10 seconds. Okay, 209k, 209k, lower than the forecast of 230k. Average hourly earnings are 4.4%, 4.4%, higher than the forecast of 4.2%. Canadian unemployment change 60k, higher than the forecast of 20k. Private payrolls 149k, lower than the forecast of 200k. So again, US non-farm payrolls at 209k, lower than the forecast of 230k. So seeing strengthening from the S&P, you've got average early earnings which ticked up. Trying to see what else there is. Average work week hours was better than expected. Earnings month on month was also better than expected as well, at spot 4%. Manufacturing payrolls was better than expected. Participation rate was better than expected. Okay, so again, the non-farm payrolls data weaker than expected. Didn't meet the 100k deviation, so not that much was needed from it. Okay, let's get that TICKSTRIKE. Okay. Let's see what the rest of the market does. Okay, let's do some measurements here. Okay, the other way. Got that. So about 27, 28 ticks towards the upside there. NQ still going higher. Okay. Let's see what the dollar yen did. Okay, so trade is easing back on bets for more rate hikes. So dollar yen 33.5 pips towards the downside. Okay. Let's see what else we got. GP CAD. So GP CAD. So GP CAD didn't really. GP CAD saw a bit of a whippy reaction here, as you can see here. So let's go. So let's go from there. Gosh, that was a mess on GP CAD. Usually the Canadian data isn't that bad. You don't get that much of a whippy data. But one thing you've got to also bear in mind is you've also got the US data at the same time too. So that can cause a bit of a distortion with the data. To see, look at the dollar yen, euro dollar. Okay. Let's take a look at gold too. I also want to look at Bitcoin as well, because that's going to be interesting to keep an eye out too. Should have then. Aha, there it is. A positive reaction there. Okay, so that's 31 ticks on Bitcoin there. Okay. Let's look at gold. Okay, so I think I need to. Okay. Market's continuing to fly here. Okay, that's gold, 169 ticks towards the upside, or 100 and yeah, probably around 169. Just kind of etch up. Let's be a bit more precise, but yeah, around 169. Oops. Hold on. Sorry, no. Try that again. Okay, 106 ticks towards the upside there. On gold. Bond prices. We'll also look at the CAD JPY too, because that was the one that had second. Usually has the second largest reaction for the Canadian data. Cool. That's 67 ticks towards the upside. Okay. All right. Okay. It's 100 and okay, so it's 12.5 pips then towards the upside in CAD JPY. So not really. So what does that kind of tell us then? That again, the US data would have come to the front, basically putting the Canadian data to the side. If you're not seeing this much of a strong reaction from the CAD data. So there was more than a 30k, 35k deviation. So 30, well, you could say 40k, nearly 40k deviation for the employment change, and even then, you didn't get a as big a reaction as you normally might have seen in the past. Okay, so a bit of a reversal there on the S&P. Okay, so again, so if you've just joined me, if you've seen the video from the beginning, and you've enjoyed the content, don't forget to share the video, like the video, subscribe to the channel, get the word out there. If you found the information, as I said, if you found the information useful. If not, then do let us know what we can do to improve or change things. Again, so if we're looking at, let's bring that out of the way. Okay. But yes, so one thing I also want to show you guys is, of course, you've seen the data on the website for non-farm payrolls. So remember, as I said, I run the service for FinancialJuice, and as the head financial analyst. So the key thing here is for you to understand, if you've never come across a new service before. So what is a live voice and text service? Well, this is something that the big boys have access to. It's used to know what's going on in the market. It's used to know why the markets might be reacting in a certain way. Okay, and also keeping an eye on the headlines that are coming through. Maybe there's been some geopolitical news that's come through between Russia and Ukraine, or maybe China has decided to actually invade Taiwan. Oh no! And then you might, if you don't have an ear to the ground as to why or what's being said in the markets, what's being said in the news, fundamental news pushes the markets, and then it's down to your technicals and what you do from then on. and then how you kind of utilize the news in your favor, in a way that works for you. So again, FinancialJuice is a live voice and text service, which allows you to understand what's going on in the markets. Somebody said, just tell me if I should buy or sell. Oh, joke. Well, I ain't in the business of doing that. Yeah. Okay, so as I was saying, yeah, so a live voice and text service, which gives you up-to-date, real-time news about what's going on in the markets and why that might be happening, and covering also covering global news as well, all in one place. So you have your live voice feed here in this little button, okay, which I've just clicked, which gives you Robert is currently on the microphone, one of our FinancialJuice analysts, has a lovely voice. Then you have the news feed here with the headlines. So again, so this is how it works. The voice goes out first. That's a priority. Okay. Then you have the text headlines that come through. Again, that's also in real time as well. So you have voice and text that comes through for you. And on the left hand side here, you have live real time economic data as well. That you can also use for your trading. All in real time. So you have everything in one place, basically, of what you need. Okay, this is interesting. So Fed swaps slightly pair odds of a second rate hike this year. So remember, markets were expecting possibly 2 rate hikes from the Federal Reserve. Okay, taking the rate to 5.75%. So again, this is also quite important too. Having the understanding of what are traders feeling at the moment, and again, how that might be driving the markets as well. Bear in mind that's post the data there for you on the feed. Again, all in one place. So what we want to do is provide you guys with a 7-day free trial of FinancialJuice. Now, so you can try out the pro version of the service. Again, having a real-time access to news is very important for a trader in this day and age, when there are lots of different things going on. Sometimes you might need the extra filter to help with understanding what is the key bit of news to keep an eye on, to understand. So if we keep, so I said I've put the link there for you in the chat. Oh my gosh, I'm trying to pin it to the channel, but this emoji thing's getting away. Anyway, it's there. It's at the bottom of the. It's the latest chat, the message that I've put to you guys there on in the chat box. But yes, so if you're not ready to sign up to Pro, or if you are ready to sign up to Pro, first thing you need to do, if you don't have a FinancialJuice account, is make a FinancialJuice account. Okay. If you want to sign up to Pro, there's a little button that says Go Pro, which will say Go Pro around here. Okay, next to this little button or this little slider here. And once you click on that and you've made your account and you've verified your account on the FinancialJuice page and you've clicked on the Go Pro bit, you can select whichever subscription you want to select, go back to the website, log out, and then log back in, and that will act as a verification for your subscription, and then you'll be able to enjoy this beautiful site that we have, which is called FinancialJuice, having all of your all of what you need, your news, your voice, and your economic data in one place as well. Okay, that's FinancialJuice there. So again, totally up to you, depending on what you want to do, whether you want to go with the live version, the free version, whatever works well for you. Okay, so that is FinancialJuice. Then let's go to TICKSTRIKE. So TICKSTRIKE, let me bring that up here for you. So what is TICKSTRIKE? TICKSTRIKE basically allows you to listen to order flow within the markets, okay? How strong or weak the buying or selling momentum is, right? So if I just bring up our, where's the other ones? Here we go. So put it another way, as I already said, it shows you how strong the buying or selling momentum is within the markets. So at the moment, let me bring up the S&P because then that'll give you a clear indication as to work best match. That's what we can see on the screen. Okay. So you have these different numbers here. Okay, so you have a number which says, so you have numbers on this here which says, which goes from 1 to 15. 1 is the most sensitive to market reactions, i.e. when there's a little bit of buying or selling momentum, as you can see there, that's a skirt that goes on, then a TICKSTRIKE will pop off with a visual and audio alert. You guys can't hear that at the moment, but you can see here that it's giving you a visual alert, and you can make that whatever you want it to be, okay, whichever color, doesn't matter, whatever it is, whatever works for you. Okay, so then then on the 15, so you can actually increase or decrease the level of sensitivity. If you go all the way up to 15 is the least sensitive to market reactions. So only when there's a lot of buying or selling momentum will TICKSTRIKE go off. So again, if you're day trading or if you're scalping the markets, then TICKSTRIKE is that other tool to add to your arsenal of trading tools that you have. Again, as said, 15 is the highest level of sensitivity, and only when the markets are showing a lot of buying or selling momentum, either way, will TICKSTRIKE go off for you. So again, as said, if you're scalping the markets, you're day trading, it's a perfect tool to add to your arsenal there. All right, so that is TICKSTRIKE, and we also have a 7-day free trial of that as well, which I'll put in the chat for you there. There it is. And then also the other thing to note as well so when I was showing the deviations for the economic releases, you guys might have been unsure as to what that is, or may have questions as to, what is that all about? Why is that color red, and why has it got them listed like that with the market reactions? So what the deviations show you is how the markets react to economic releases. Okay, and how noting how big the reaction is, the initial reaction is, and then how and then 10 minutes later, after the release has come out, what the reaction is for you, and then that way you can kind of gauge, okay, which asset is going to have the bigger reaction, or generally has the strongest reaction within its group. Compared to some of the other assets within the group. Okay, that's what the deviations are used for. I've had people requesting, saying, "Hey, do I have to pay for this?" Nuh-uh, it is completely free for you guys to have a look at of this information. So again, deviations not just for non-farm payrolls, but you can see I'm looking at GDP there. Not just for non-farm payrolls, but you can see that there are other economic releases that we cover as well on our side for the for the different bits of economic data that we get. So CAD employment change data, which of course we had not so long ago. ADP employment change. If you hadn't seen that last time, if you hadn't received the email on Sunday, you would not have maybe not have seen the deviations and how the markets would have reacted last time round for you. Okay, so again, this is completely free, and how do you get access to this is your next question. So the way you get access to this is you can sign up to the MACROACE mailing list. It's, as said, completely free, no charge. You can jump on, sign on to that. What you'll get is an email every Monday, giving you giving you a week ahead of what to expect, and that's first of all, you get the deviations for the upcoming economic releases, the ranges as well for the upcoming economic releases for that week, and also the live stream links as well. Okay. So one other thing to bear in mind as well is that if you're thinking that it's full of charts and infographics, no, it's not. It's just short and simple, because in the videos and the live streams that I do is where I explain more of the detail about the economic releases and what is the sentiment surrounding those economic releases. So again, that's just something to be aware of. Again, as said, so it's not big. They're just short paragraphs of what to expect in Asia, US, and Europe, the European session in the week ahead. So that is the deviations for the economic release. Also don't forget we have unusual activity. So if you like trading high probability stocks, futures, FX, and crypto breakouts in real time, you can also sign up to unusual activity there as well. Other than that, we've got Bank of Canada next week, where they're expected to hold their rate after their surprise rate hike that they took last time round. Join me for that Wednesday. We'll, again, as said, Monday, you'll get an email if you have signed up to the MACROACE mailing list. But don't forget to like the video, subscribe to the channel, get the word out there if you found the information useful, and I will see you guys next time. All right, take care.